Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I trust your week has gone well for you and the weekend will be a very pleasant one indeed. Markets really still about the US debt ceiling. Of course, equity markets in the US trading zone yesterday were looking very, very heavy as if they were beginning to fall away. But again, there was leaked gossip that talks are progressing on the resolution of the debt ceiling discord, and that of course gave markets a boost over the last few hours of trading yesterday in New York. So the market ended the day looking very strong, and Australian markets have opened quite firm as well. And I guess what's going on is the old battle really of just masses of money being available, cash floating around from all this money printing and government stimulus and ongoing government spending, versus perhaps the common sense of the reality of the economic plight of the United States and the outlook for revenue. Of course, some of the big tech companies now are being seen as the safe haven option for many in the market, thinking that the US economy could well slow, the global economy could well slow. But these titans, these global brands in the US, such as Google, etc., are in fact servicing a wider market. And much of the economic slowdown the world is seeing is in the Western economies. And therefore, you can still benefit from a rest of the world growing faster economic scenario, if you like, in much of the world we don't talk about too much, where things are looking a lot better than they are in the Western economies at the moment. So in the US, obviously, we saw a fallback in new jobless claims yesterday, and that will continue to put pressure on the Federal Reserve to raise interest rates. They are wanting to wait and see the full impact of previous rate hikes, but at the same time, inflation remains very firm, and core inflation could even be stabilizing at rather extreme levels. And this is something that is really a nightmare scenario for the Federal Reserve, and they won't want to be seeing that establish itself much further. Therefore, there is the chance, of course, the Federal Reserve will be pausing at its next meeting, especially in an environment of a US debt ceiling crisis. There is absolutely no way the Federal Reserve will raise interest rates if the debt ceiling situation is not resolved. Of course, we know that the absolute debt level remains a massive crisis for the United States. I mean, since the 1980s, it's come from near 30% debt to GDP to actually up around 130% now. And that 30% hike was really just in the last few years over COVID. But the problem is post-COVID, as I've mentioned before, US government spending continues to increase, which is quite extraordinary. I mean, US government spending was already extreme before COVID. It jumped up a big level, like by a third, and then it's continued to go higher even as the COVID crisis fell away. So really out of control spending in the United States now. It just really is. It's completely diabolical, and it cannot end well. Once you get up to around this 130% of GDP level, you start to get into, I hate to say it, but almost third world debt sort of leaning situations, and they never end well for any country. And throughout history, the end of empires has been marked by that kind of government debt to GDP getting out of control scenario. So the United States really needs to do something, which is partly why the Republicans are digging in their heels, and the Democrats, wanting to keep winning elections, are digging in their heels to keep spending as well. So a very difficult situation there. We are all hopeful of a resolution, but it's by no means a definite scenario. So do keep in the back of your mind, there's 10% chance still of a default. I've dropped that from 25 to 10 because there does seem to be some ground being made between McCarthy and Biden administration officials. Biden, of course, has done a puncher's pilot. He's washed his hands. He's gone to Tokyo for the G7. Meanwhile, President Xi of China is holding his own meeting of 6 countries not far away, and that in the western city of China, Xi'an. And over there, they are, of course, solidifying a regional land sort of based economic bloc to rival the disarray, if you like, of their China Sea situation. So looking for cross-country transport routes that don't go through Russia and Ukraine. So China looking to diversify its transport routes to go across the continent towards Europe, which is probably a very good strategic move. And they, of course, are including Russia in their conversations on that, and that is only to be expected. So the G7, though, in Tokyo just wants to go harder on sanctions against Russia. And we already know that sanctions against Russia have hurt the West substantially and have also triggered some economic discord in the West, and have also intensified the closeness of the relationship between China and Russia. So more sanctions means more of movement in those directions as well as harming Russia. It will do all of the pre-mentioned things as well. So this is not good for the global economic outlook, actually. As much as, you may want to fight against Russia for Ukraine in this war, these sanctions it doesn't matter your political view on that subject, these sanctions will hurt the global economy further. So not too much, but to some degree. So, and of course, there could be retaliatory sanctions by Russia or trade actions by Russia. So overall, still we're by no means in the scenario of the Ukraine war is behind us as an economic impulse on the global economy. So we all hope for a peaceful resolution there as soon as possible. On economic data, as I was saying, those new jobless claims, they fell back after an aberration to the upside that some people are saying may not have been an accurate reflection of the reality in the previous month's number or the previous week's number. So that number has fallen back sharply, and that puts a little bit more pressure on the Federal Reserve to keep hiking interest rates. I guess what I'm trying to get to with the Federal Reserve outlook is that we could be in for a slow hiking period from the Federal Reserve. That is that we will continue to see interest rate hikes from the Fed, not cuts. Interest rate hikes from the Fed, but in a more gradual process of every second or third meeting until they're sure that that core inflation, stubbornly high, extremely high core inflation that is stabilizing, even re-accelerating, is well and truly defeated. And this is something that markets are not accurately pricing and could well need to do in the coming weeks and months. So just watch for no rate hike. If there's still a debt ceiling crisis, even if there isn't a debt ceiling crisis, there could be a miss of a meeting. That doesn't mean the Federal Reserve is finished raising rates. Have a great weekend. Clifford Bennett, Chief Economist, ACY Securities.